Thanks for tuning into Talking Point. I'm your host, Niraj Shah. We've divided Talking Point into two. We're starting off with one of the newsmakers of the day, and that's Apollo Hospitals. Remember, Apollo Hospitals has proposed to infuse equity capital from Advent International at Apollo Health Co level and has to integrate Keimed Private Limited with AHL. Joining me to talk about the transaction is Mr. Krishna Akhileshwaran. He's Group CFO of Apollo Hospitals Enterprise. Mr. Akhileshwaran, good having you. Thanks for taking the time out. Neeraj here. Good morning. The reaction to this deal, which was much anticipated, seems to be from the assumed valuations for AHL, which is Apollo Healthco, of course, at $1.75 billion, much lower than what analysts estimated the one-year forward valuation to be like. Can you explain, one, the transaction and the valuations at which the transaction has been done, and why have these valuations been taken?
I think I think this is an immediate reaction which has come from the market, and I think we should just respect that for now. But the point is, all the analysts were building in a number of 17,000 to 18,000 crores for the Apollo AHL business. But the way analysts look at it, they look at it as FY26, forward multiple, etc., to come at this number. If you look at the money which is coming in from Advent, which is a reputed private equity player who's coming into the business, it's coming in today. So clearly, money which comes in today, yes, it's coming in today at a valuation of 14,478 crores, so around 15,000 crores. I think, roughly around, 1,500 to 2,000 crores lower than what analysts were expecting. So I guess, and that's in some way, we'll have to understand that it was something that they were doing based on FY26 forward, whereas this is money coming in now. So, I think we will clearly see that from now on, as we look at the business, I think it's going to be significantly value accretive to the business. I am not overly concerned about the current stock reaction because, it's a deal which is a bit complex. People are trying to understand and assess what's Keimed going to do, etc. I think it's a normal reaction that the market is having, but we are quite sure that over the next few days, as people understand this transaction better, they will realize that the combined entity that we are putting together is going to be a powerhouse and then the pharmacy distribution and omni-channel pharmacy business, which should only be significantly value accretive to the Apollo shareholders at large.
Got it. And okay, so I will take that question as well as the third one about you presenting what the powerhouse entity could be like and why so. But just one question, since you mentioned Keimed as well. One of the notes seemed to suggest that Keimed's valuations, and correct me if I'm wrong here, but have doubled over the last 1 year, despite EBITDA largely being flat and 40% of the revenue coming in from Apollo alone. So has there been, is there a financial methodology by which Keimed has been valued as well? And why is it that there is a discrepancy again between what the street was thinking of, informally otherwise, and what has actually been done?
So 2 points. I think, as you said, one of the reports have carried this, but 9 out of the 10 reports have not had any perspective of valuation at all of Keimed, and they understand this business. Because if you look at Keimed, firstly, Keimed has been meticulously built by the Apollo, the promoter family, over the past 20 years, and that they have acquired 19 significant subsidiaries over time, all of which have been legacy promoters of their own. None of them are related parties. They have been regional players. See, the distribution business itself has to be understood by the market. It's a highly fragmented business, 60,000 odd distributors who have been there. And some of the best distributors are now part of Keimed because that's the way that Keimed has grown with time. So the related party transaction that you are talking of, and the fact that 40% of Keimed gives to supplies to Apollo is primarily because it's the other legacy operators or the legacy partners who have been supplying to Keimed. Keimed, over a period of time, has acquired 51% stake in some of them as part of their business model, which is why, clearly it appears as though, 40% is coming to Apollo, but all of them have been legacy. Point number one. Point number two, to your point of Keimed valuation, if you look at, the closest listed peer, we are at 0.8 times sales. That is what is being valued of Keimed, whereas this is at 1.1 times sales. We are valuing Keimed at, what has the Keimed valuation implies 18 times forward EBITDA. And that's again been valued by Advent clearly basis what they understand of the market. And I think it is all above board. I think we will have to face the one odd report because it is a related party transaction which is coming in. But let me assure you one thing. We will, most of the investors, shareholders who understand us, the FIIs have all been asking for this to be merged with Apollo because it cleans up the structure. It ensures the related party is completely behind us. And I think we'll have to look forward to what it's going to accrete as value to the shareholders again. So I think, it's unfounded, some of these perspectives of valuation. The broad market understands it, and we are here to answer your questions.
Great. And you're doing that well. So thank you for that. So just one quick follow up there. So you are saying effectively that the valuation which was ascribed to Keimed 1 year ago, which was maybe 0.4, because the current valuation 0.8 you are saying is reasonable, but it has doubled over the past 1 year, if I'm not wrong.
No, I will have to correct that also. A year back, the valuation, equity value at which some of these minority investors, see, even before we did this deal, there were minority investors in the minority partners in this, as I said, all of that had to also get folded back into Keimed. Bulk of that has been happening at an equity value of 5,000 plus crores, whereas the current transaction is at 6,400 crores of equity value. So not as though, I think the market has picked this.
Yeah, 28%. 28%.
So 5,000 to 6,400 crores. And that is over the last 15-month period. And the sector itself has got re-rated. Because clearly, if you look at some of the other transactions in this sector, unorganized to organized is a big play. And we are the largest in the industry today. The sector has got re-rated also. This is the only perspective. Even today, I am again repeating, the transaction is at least at a 25% discount to the closest peer which is listed in the market.
Yeah, and that I appreciate. I think the only question, and okay, so it's 28% and not 50% based on the 15 months ago. The question mark was only that has the EBITDA stayed stagnant while the valuation has gone up? But okay, that can be, 1,000 ways to slice and dice. So yeah.
Let me answer that also.
Okay,
EBITDA has stayed a bit stagnant only because some of that EBITDAs have got passed on to Apollo Healthco Limited. Because, if you remember, Apollo Healthco Limited has embarked on this omni-channel pharmacy, that the discounts in Apollo Healthco has also been higher in the omni-channel pharmacy business. So some of the discounts have also got passed on by Keimed here. But some of that is now behind us because, as now the discount structure in this online pharmacy has come down to close to 12%. We will see Keimed expanding its margins from here on, and more importantly, continue on its stated 20% growth that we have ahead of it.
Okay. Now, do talk about the powerhouse that you mentioned. What's next? Now that this has been established, yes, it's a strong franchise across multiple touch points as well. What happens next in terms of integration of all of these, and how do we see growth for this entity?
I think, we have already guided. That's the important thing that the market should appreciate and understand. We have already guided that this combined entity, which is Apollo Healthco with Keimed, in 3 years from now, will get, we have guided a 25,000 crores revenue for this combined entity, which will be very large, which is the combination of the omni-channel pharmacy business that Apollo is serving to in Apollo, as well as the outside 65,000 odd pharmacies that it has, and a 7 to 8% EBITDA margin, which means, implied EBITDA margin of EBITDA of 1,750 to 2,000 crores is something that we can expect of this in the next 3 years. And we will still, as Apollo, own 59.7% of this entity as Apollo shareholders. So I think even if you look at the value uptick that will come because of that, I think the market is overreacting. I think we'll have to leave it at that and hope that with time we are able to deliver to what we have committed.
Yeah, well certainly hope so. Where do you think this largest point of growth will come in? And therefore, I don't know about, excuse me for not knowing whether you're in a silent period or no, but the summation of some of the notes that I've read also speak about the resultant impact of all that you're doing at the Apollo Hospitals enterprises level and what kind of earnings CAGR comes in out there. Could you maybe talk about both of these, Mr. Akhileshwaran?
So this is Apollo Healthco alone, right?
Yes,
the 25,000 crores is Apollo Healthco alone that we have said in 3 years, which can get to. Apollo Hospitals itself is growing at mid-teens. We have a 10,000 crores hospitals business, which itself is growing at almost around mid-teen levels, and we have guided to margin expansions there. We have already said we are looking at bed additions of 2,000 beds over the next 3 years with 3,000 crores of capital. The capital that is coming now from advent of 2,475 crores. You would also have read that 890 crores out of that actually comes to Apollo Hospitals itself. Because of the slump sale that we had done of the business in the past of the pharmacy distribution business, which also comes back to us, which also helps us on the overall growth trajectory. So this 25,000 crores, the way you should look at it is that clearly the Apollo pharmacies, if you look at the Apollo pharmacy business to which Apollo Healthco supplies to, it is this year at approximately 10,000 crores of this even today, and this will continue to grow. And the distribution business will also continue to grow. The important thing in the margin accretion is the online losses, which we have said will come off to zero in 6 to 8 quarters, which is a key measurable. And I accept and agree that that's something that we will have to continue to work on. And this is the big delta, which will take the current combined EBITDA margin of close to 2%, if we had combined Keimed on a pro forma basis, to almost 7 to 8%. There is not the margin expansion otherwise is quite natural.
Just one last question there for Mr. Akileshwaran on that. When do some of these statistics start bearing fruit and for you to be able to show as well? Because I believe the transaction will take time to complete. You'll take time to integrate what have you as per the legalities and then show the combined numbers. So when do we see these combined numbers getting declared?
See, we have been quite transparent with the markets in the past. We'll continue to hold that level of transparency. We will continue to provide, we will attempt to start providing a pro forma numbers of Keimed also to ensure that the market appreciates that the progressive incremental value that is being ascribed is something that it gets to see to believe it. That's something that we will do from the coming quarter itself.
Great. Okay, Mr. Akileshwaran, we would love to talk in detail about this once we talk about your quarterly numbers overall. But thanks for speaking to us and thanks for clarifying some of the doubts that the street has. Much appreciate your time.
Thank you so much, Niraj.
All right, that's the Group CFO of Apollo. Stock still down about 7.5, recovering off the lows of the day, but still down 7.5. I think what the management tried to explain was the reason why the valuation was what it was. Some part of the analyst community not quite happy with the way it was done. Hopefully these explanations help in some fashion. Let's see what the stock does during the course of the day or the week or the month. Well, Vinay Jaising joins in on this part of Talking Point as well. And Vinay, thanks so much for taking the time out. Usually do a much longer conversation. Today will be slightly shorter, and we need to slip into a break as well. But before we do that, Vinay, can I start off with a bit of a micro, because we've just talked to Apollo Hospitals. We've seen what's happened to some of the CDMO players last week on the results. Some of the pharma exporters are now talking of some fairly positive commentary regarding Revlimid and some of the others on the specialty sales. What have you made of all that's happening in healthcare? And if you have some view on the hospitals business, particularly because Apollo is in news today.
So, Nirav, thanks a lot for this meeting. When it becomes difficult not understanding what's happening in China especially and what's happening to commodity prices, we believe, go to your strength. And the strength in the pharmaceutical and specialty chemical sector is domestic. So our focus is really on those companies which have good formulations, looking at domestic markets which are growing pretty well. And here, we like companies, be it companies like Ajanta Pharma or RPG Life Science, which does not have much to do out of Asia, at least. It's largely into Asia or more so into India. They're growing with the domestic formulation market, growing probably 5 and 8% respectively higher than what the domestic formulation market are growing. So for us, it's much easier to look at companies focused on this than companies focused on CDMO or companies focused on the US generic. Having said that, contract manufacturing is something we really like. Here, niche players where you're pretty confident on the market share, companies like Blue Jet is where we would focus on, because they've got not one but three legs for growth. One is the intermediate ink. The second is their API, And the third is, the concentrates which they make for sugar-free. So, when you have a couple of legs of growth and a disproportionate market share globally, you're bound to do well. So that's the way I would look at it. As far as hospitals are concerned, we're currently being away from them, largely because of their relative last 2 years outperformance. And more importantly, we think the return on capital employed for most of these domestic formulators or even companies like Blue Jet are a lot more higher.
Vinay, are you worried about what could happen to risk assets, particularly equities, because of the valuations that we are trading at and the linkages that you derive with global yields versus earning yields and a few others? Or are you a bit sanguine about the prospects, particularly Indian?
So my perspective, you're close to the worst being behind you, because if you look at the interest rate yields of US, the 2-year, 10-year chart, though it's got worse now, you're pretty much close to 4.5 to 5%, so a negative yield of about 0.4, 0.5%. And everyone's talking about interest rate cuts, whether it happens in 6 months or 9 months, but interest rates cuts are come. You're pretty much close to peak, apart from countries like Japan, where they're having some interest rate hikes. Everywhere else, you'll see interest rate cuts. So when you do see interest rate cuts, technically, the economy does get better. The cost of doing any kind of business does improve. But this 3 months to 6 months, you'll start hearing a lot more about what has happened for the high for long interest rate scenario, which means you'll hear a lot of news which is negative on the global front on slowdowns of projects for the next 3 to 6 months or probably 9 months. So I would be concerned about, just exports or global slowdown much more than a recession. But I think with interest rates being at its peak, if I were a one-year investor, there's a lot of reasons to really smile out at.
Okay.
One comment out here, obviously the geopolitical risk, which neither you nor I can take a call on, because of which crude is north of $90. That's something which all of us investors will have to focus on.
It's a bit of a moving target to focus on, Vinay, you're right. Just wondering though, I keep on hearing conflicting comments about the Indian valuations as they stand, and what could that mean, because the quantum of earnings growth that the markets needs to show for the valuations to justify. What's your sense here, and what pockets within this landscape do you reckon will live up to the earnings growth? Because the markets may well turn out to be a bottom up or a sector or a stock specific market as opposed to a rising tide carrying all boats.
I would agree totally with your last comment. But firstly, on the first part of it, when we look at the Indian markets, if you look at the larger cap markets, you look at the broader indexes, they are not the same as what they were 5 years ago. There's a minimum change of 30 to 35% in terms of number of stocks, and even higher in terms of the PE. So if you're looking at, let's say, BSE 30 or Nifty 50, and you're looking at 20 time 1 year forward multiples, remember there's an Adani enterprise which has come in and a Vedanta which has gone out. So you can't compare valuations to the past because the index level is not just the same. Having said that, I think what's important in India in the next 3 to 4 years is the stability which has come in the past is here to stay. You're seeing the incremental GDP growth increase. We're adding about incrementally 15% of the world's GDP, but we're adding only 1.5% of the world's profits. And that's the same number we have in terms of the overall weightage India has in the overall indexes. It's too small. When we're talking about being the third largest player in terms of GDP in the world in the next 5 years, our weighted average number of 1.5% in everyone's portfolio globally is just too small. Having said that, I think look at a couple of things for India which are going our way, and lots of them are technical. I know you spoke about growth, but we'll reach there. First and foremost, the FII ownership in India is about 16.5%, too low. Last year saw a $25 billion inflow from FIIs and a $25 billion inflow from SIP and pension funds / PPFOs. So you saw a lot of sticky money come into the country last year of $50 billion. If FIIs were to go up by another 3.5%, go to their peak of 20% in this $4.3 trillion market cap country, you'll see as much as $150 billion of inflows come. Now, that's not going to come one time. That's not going to come probably pre-elections. You're in the next 3 months going to have elections behind you. And post that, I think there'll be a lot of liquidity coming in globally. Domestic liquidity also looks really good. The second big trigger, I think, when you're looking at India is so far it's only the government which is focusing on capex. Obviously, the BJP manifesto made us all smile. There was the word manufacturing, which was written 59 times in the manifesto. So clearly, capex is something which the current government will, if they come into power, will focus on again. But the corporate capex, once it starts growing, you'll start seeing the Indian economic growth being even faster than the 6.5% to 7%, probably inch up by 1% in the years to come. That's exciting. Earnings growth, even if you look at results which have come up currently, they're at the 16-17% level, but we are obviously at the start end of result season. But if I look at bottom up, you're seeing about 15+% growth come up this year, and then higher growth coming up in the longer term based on our analyst growth. On your last question on pockets of growth and what would one focus in, I'm just sticking to what we learned from the BJP manifesto, and our areas of comfort are in the capex cycle, in the PSU cycle, in telecoms and autos. Now out here, you've got power, utilities, you've got capital goods, so you've got water, you've got defense. All of these are make in India stories or purely for India stories. Out here, if the earnings growth is north of 20 to 25% and the valuation are lesser than 30, in some of these cases are 10 to 15 times 1 year forward earnings, I think there's enough of pockets of growth. Coincidentally, all these sectors happen to be largely in the small and mid cap space. So I would focus a lot more on bottom up in the themes I just mentioned. They happen to be in small and mid cap, a lot more than large cap. So that's where I think there are pockets of growth.
Well, good to know. A lot of people are skeptical on mid caps. Good to know that the pockets of earnings growth stay out there. We have just about time, a couple of minutes left for the show to end. Based on earnings thus far, I was just looking at the Q4 thus far. It's a very micro way of looking at it. But I was looking at Q4 thus far. Solar companies, AMCs, maybe hotels, maybe real estate. These are the ones which have stood out in terms of earnings growth. Does the buck follow those? Or will the buck follow estimates of what could happen maybe first half, second half, FY25?
So, interesting question. I'm just going to put an angle question to you. What do you think are the small cap and mid caps in this full weightage which have done well? So just smiling, but I kind of gave the answer of the previous question. Most of the companies where the results have come out and where the earnings are good are small and mid cap companies. If it's consumption in those particular sockets. Capex per se, just because the order book, remember India's growth in capex in the year 2024-25, just the incremental growth is as much as what they added totally in the year 2014, which was 1.6 trillion. So seeing the impact of that, you obviously saw that in Sterling and Wilson Solar, but you'll see the impact of that come up in a lot of capital goods sectors. Here, the large cap space, where they've not got earnings, in the financial space, you've already seen the trajectory come down for the large cap, from 35-40% plus levels to 15 to 20% in line with their loan group. Some NBFCs and wealth companies have done better. So when you're looking at it, you have to be bottom up. But again, I'm repeating, the large cap earnings growth are slowing down. That's unfortunate. Having said that, if you're looking at India, you want to be in growth. I think you need to be waiting for a quarter or two to see if corporate capex growth makes the large cap grow further. But the equipment vendors, who are getting the orders, they're doing really well now. One more comment, if you're looking at global names like IT, wherein the results have come out, which are literally tepid, flat numbers on a year-on-year basis on the top line. I think the pain is still to come out there in the next quarter or two. So we would be wary for that sector, at least in the short to medium term.
Okay, Vinay, we'll leave it at that. Thank you so much for taking the time out and being with us. But today was a truncated version of Vinay Jaisingh's time with us because of some compulsions that we had. Look forward to talk to you on a full-blown conversation soon.
Cheers.
Right, and viewers, that's it on this leg of Talking Point. Thanks so much for tuning in.